Hey everyone, welcome back to my channel. Today we're going to talk about the factors that can affect the stock market and ultimately impact your investment decisions. If you're someone who's new to investing in the stock market, then this video is for you. Understanding the market and its various components is crucial to making informed decisions and avoiding any financial losses. So let's dive right into it. Here are the top factors that can impact the stock market. 1. Economic indicators. The first factor that can affect the stock market is the country's economic indicators. These indicators provide an overall picture of the country's economic health. For example, GDP growth is an important indicator as it shows how much the economy is expanding. High GDP growth indicates a strong economy, which can result in a bullish stock market. On the other hand, low GDP growth can indicate a weaker economy, which can result in a bearish stock market. Inflation rates are another important economic indicator. High inflation rates can lead to high interest rates, which can decrease consumer spending and business investments. This can cause the stock market to decline. Low inflation, on the other hand, can lead to lower interest rates, which can stimulate consumer spending and business investments. This can cause the stock market to increase. Employment data is also an important economic indicator. The unemployment rate, which can impact consumer spending, as unemployed people tend to spend less, can indicate a stronger economy, leading to an increase in the stock market. So higher unemployment rates can indicate a weaker economy, leading to a decrease in the stock market. Interest rates. The second factor that can impact the stock market is interest rates. The Federal Reserve sets the interest rates, and any changes can impact the cost of borrowing, which can impact consumer spending and business investment decisions. When interest rates are low, people tend to borrow more money, which can lead to higher consumer spending and business investments. This can cause the stock market to rise. On the other hand, higher interest rates can lead to a lower consumer spending and business investments, leading to a decrease in the stock market. Geopolitical events. Geopolitical events such as wars, political upheavals, and natural disasters can create uncertainty and impact global supply chains. Such events can cause volatility in the stock market and disrupt the economy. So, for example, political unrest in the Middle East can cause oil prices to increase, leading to a decline in the stock market. Corporate earnings. The performance of individual companies can impact the stock market. Investors look at financial metrics such as earnings reports to gauge the health of the economy. Good earnings reports can cause a spike in the company's stocks, whilst poor reports can lead to a decline in stock's value. This can cause a ripple effect throughout the stock market, as many other companies in the same industry may also be impacted. Government policy. Changes in government policies such as tax reform, trade policies, and regulatory changes can impact specific industries or sectors of the market. For example, the renewable energy sector might see a boost if the government provides subsidies to companies that use clean energy. On the other hand, if the government imposes tariffs on imported goods, companies that rely on those goods may see a decline in their stock prices. Market sentiment. Market sentiment refers to the overall mood of investors. If investors are optimistic, then they will be more likely to buy stocks, leading to an increase in the market. Conversely, if investors are pessimistic, they might sell their stocks, leading to a decline in the market. Factors that can include market sentiment include news events, economic indicators, and corporate earnings reports. Technological innovations. Advances in technology can disrupt traditional industries and create new opportunities for growth. This can impact the stock market as investors seek to capitalize on these trends. For example, the rise of e-commerce has led to a decline in traditional retail stores. Companies that have embraced e-commerce, such as Amazon, have seen their stock prices rise as a result. Natural resources. The availability and price of natural resources, such as oil, gas, and minerals, can impact the stock market, particularly for companies in the energy and materials sector. Changes in supply or demand for these resources can impact the prices of commodities, which can in turn impact the stock prices of commodities that produce or use these resources. So, for example, if there's a shortage of oil, the price of oil will increase, which can benefit companies in the energy sector that produce and sell oil. On the other hand, companies that rely on oil as a major input for the production may see their costs increase, leading to a decline in their stock prices. Currency exchange rates. Finally, exchange rates can impact the stock market, especially for companies that operate in multiple countries. A weak currency can make exports cheaper, which can benefit companies that export goods. On the other hand, a strong currency can make imports cheaper, which can benefit companies that rely on imported goods. For example, if the US dollar strengthens against the Japanese yen, US companies that export goods to Japan may see their sales decline as their products become more expensive for Japanese consumers. Conversely, Japanese companies that export goods to the US may see an increase in their sales as their products become cheaper for US consumers. Overall, these factors are important to consider when investing in the stock market. It's important to stay informed about economic indicators, government policy changes, and corporate earnings reports to make informed investment decisions. However, it's also important to remember that the stock market can be unpredictable, and past performance does not guarantee future results. It is important to have a diversified portfolio and to consult with a financial advisor before making any investment decisions. So there you have it. These are the top factors that can impact the stock market. Thank you for tuning into my video. If you like this content, don't forget to give it a thumbs up and potentially share it with your friends. Thank you.